There are thousands of stocks trading in the US market right now. Sadly, most of them will underperform the S&P 500 this year. Even worse, some will lose money, maybe a lot of money. The whole game in stock picking is finding the rare few stocks that actually have the wind at their backs, great growth outlooks, and timely investor attention. Today, I'm bringing you 5 names that fit that bill. One is making the specialized materials behind the next generation of aircraft. Another is a large cap that just delivered a game-changing earnings beat that the market hasn't properly priced in yet. Most exciting is a beaten down small cap where multiple top-tier Wall Street analysts are calling for triple-digit upside. To get all that and more, then please keep watching to the end. By the way, I'm Steve Reitmeister, former editor-in-chief of Zacks.com and now a partner at WallStreetZen.com. Our quant team runs 4,600 stocks through 115 different factors every trading day to find the names with the highest probability of beating the market. Today's picks are the ones flashing the strongest signals right now. And if you want to see more breakdowns like this from us in the future, then please hit that like button below. It tells me to make more videos like this down the line. Okay, one last note. Before I get to those 5 stocks, investing carries risk. You should always do your own due diligence before making any investment decisions. Okay, let's get into the first stock in Tutor Perini with a symbol of TPC. This stock is up over 100% in the past year, and our system is flagging it is still a buy, given its still impressive upside potential. They are a diversified general contract. I know that might not sound super exciting, but bear with me for a second. They basically build major infrastructure projects. We're talking about bridges, transit systems, public buildings, airports, water and sewer projects. The type of work that gets funded by federal and state infrastructure spending, the kind of work that has years of backlog visibility once the contracts are signed. Why does this matter right now? The forward earnings forecast from Wall Street analyst community calls for over 100% growth in the next year alone. This is not just guesswork because it's based on their massive $21 billion backlog of business. Truly years and years worth of contracted projects already booked and locked in. The Zen Ratings quant model is picking up on this impressive profile. In fact, Tutor Perini scores in the top 13% of all stocks across our review of 115 different factors that point to likely outperformance. As we drill into the Zen component grades, we see strength in the following areas. We're talking about top 20% for growth, top 16% for value, and top 10% for safety. That is a tantalizing combination. This certainly explains why Tutor Perini was recently selected as my stock of the week. This means that it cleared not just our quantitative model, but also my personal review of a stock likely to outperform in the future. The main risk here is that government contracting carries political and budgetary cycle exposure. If federal infrastructure spending slows or contract timing slips, then the earnings lookout and share price would suffer. But let's be honest, when was the last time the government spent less money? Yeah, good question. But overall, this is a well-positioned company with $21 billion in contracts already in hand, leading to great visibility of growth ahead. Now tack on its top grades in the Zen ratings, and you understand why it's a stock on our list today. All right, now let's move on to stock number 2 with Betterware de Mexico with a symbol of BWMX. This is a Mexican company that most U.S. investors have never heard of, yet our quant system is flagging it as one of the best stocks to buy now. Betterware sells home organization products, kitchen items, and food solutions through a network of distributors and online channels. Yeah, kind of sounds like Tupperware. In fact, earlier this year, Betterware acquired Tupperware's operations in Latin America. They're the largest direct-to-consumer player in the region with a proven distribution model that's hard to replicate. Why does this matter? For as much growth as they have had, it is not properly reflected in the stock price. In fact, they are trading at less than 1x sales. That kind of valuation of a company that's growing earnings the way that Betterware is highly unusual and highly attractive. Back to the special growth story. Not only is revenue on the rise, but so are profit margins, leading to 72% year-over-year earnings growth. Now, on the analyst side, we have 2 top-rated analysts covering the stock, both giving strong buy ratings and both pointing to fair value above 30, which implies over 80% upside from the current share price. Now, let's talk about the Zen ratings profile, where Betterware is not only A-rated overall, but actually in the top 1% of all stocks we track. The component ratings show broad-based strength across the 7 different aspects we review. This includes 5 areas in the top 20% of all stocks. We're talking about growth, financial strength, value, safety, and our proprietary AI factor, which sifts through mountains of data to detect subtle patterns that could lead to timely outperformance. It's like the opposite of a one-trick pony. There's no single component carrying the whole bullish thesis. It's incredibly well-rounded and attractive. The main drawback for Betterware is the same as for any international company. You have both currency and economic risks relative to the areas they play in, which is Mexico and broadly Latin America. But that is also part of the appeal, given the expanding middle class in these countries, all the more likely to buy this appealing array of products. Again, Betterware is in the top 1% of all stocks for its stellar fundamental profile. This is why Wall Street analysts are pounding the table for over 80% upside in the year ahead. Just realize this is a small cap with a bit more risk than the average stock, so do size your position accordingly. If you want more breakdowns like this on stocks our quantitative system is flagging week to week, then please hit the subscribe button and turn on the notification bell. I publish stock analysis videos frequently. Staying up to date could be the difference between catching a name early versus discovering it after a significant move has already taken place. Now let's keep rolling with stock number 3 in Constellium, the symbol of CSTM. Constellium is a global manufacturer of aluminum rolled products and structural parts. Their largest customers are aerospace giants and automakers. This means they sit at the intersection of two big industrial trends: the aerospace recovery and automotive lightweighting to enhance fuel efficiency. Now, recent earnings reports proves this out with nearly 100% annual earnings growth over the past 3 years. Their financial efficiency is truly remarkable, with return on equity over 46%. That's nearly double the industry average. All this growth and financial prowess, and yet shares are only trading for 9 times forward earnings. That is a screaming value for anyone paying any attention. In our Zen rating system, Constellium is rated A and ranks in the top 2% of all stocks we track overall. This is elite territory thanks to a wide array of strong component grades. Top 19% for sentiment, top 12% for value, top 11% for growth, and top 9% for momentum. What's not to like about all that? If there's a potential issue with Constellium, then it would be that aluminum is a cyclical commodity. So if the aerospace ramp slows or EV demand softens, which is not going to, then the operational leverage that's been working Constellium's favor can work the other way, lightweighting these shares, right? But when all is said and done, the positives far outweigh the negatives here. You've got impressive growth, operational excellence, and a surprisingly low valuation. That should keep shares on the upswing. Now let's go in a different direction with stock number 4 in Cardinal Health, the symbol is CAH. This is a large cap that most investors think they already understand. The data begs to differ. Cardinal Health is one of the largest healthcare distributors in the United States. They distribute pharmaceuticals and medical products to roughly 75% of U.S. hospitals, and they manufacture medical and surgical products in their own right. This is a mission-critical infrastructure that doesn't go away in a recession. It goes without saying that hospitals still need their drugs and scalpels, whether the economy is booming or not. Cardinal Health just delivered the kind of quarter that should turn heads thanks to a 13% earnings beat. Remember, we're talking about a large cap healthcare company. That type of beat is rare for a company of this nature. And this is not just a one-quarter story. Cardinal has now beaten Wall Street estimates for 15 quarters in a row, and the past few years has generated impressive 30% annual earnings growth. And gladly, the growth party seems far from over as management just raised its full-year guidance. Here's the part that was most interesting. The stock is actually down over the last 3 months. The sound you hear now is opportunity knocking, right? The Zen ratings most certainly concurs with that bullish notion. That's because Cardinal Health is rated A overall, putting the top 5% of all stocks we track. This combines top scores in areas like growth, value, safety, and sentiment. Now, that sentiment part says the smart money is jumping into the shares. Often aside, we should take their lead and join up, especially with growth and value being so appealing at this time. And by the way, before I get on to the last pick, a quick note. This is exactly the kind of analysis I walk through live every Monday at 7 p.m. Eastern Time. Not just what I'm buying, but how I'm finding it so you can do the same. I also share my hand-picked stock of the week, blending the power found in the Zen Ratings model with my greater than 40 years of investing experience. All this and more is part of our live training session this coming Monday at 7 p.m. Eastern. It's totally free. Just sign up at wallstreet.com/live. You'll also find a link in the description or scan the QR code on your screen. Now on to our fifth and final stock in MNTN with a symbol of MNTN, but most investors just call it Mountain. The market has practically given up on the small cap, and that's exactly what makes the investment story so compelling. The company runs a connected TV advertising platform. Now, connected TV means streaming services, smart TVs, and the way most people actually watch television in 2026. Mountain's platforms lets businesses buy ads across that ecosystem the same way they can from like Facebook and Google, very targeted to specific audiences and very, very measurable. Mountain hit a 52-week high above $30 per share less than a year ago. And as a recording, shares have endured a bit of an avalanche since then, right? A drop like that usually means one of two things. Either the company is broken or the market has overreacted, creating a buying opportunity. Our quantitative system is clearly telling us it's the latter. Wall Street analysts seem to agree with that bullish assessment, given 6 buy and strong buy recommendation. Even more telling is the average 12-month price target, implying more than 150% upside potential in the year ahead. That's the average target, whereas the street high target of 26 implies over 200% potential upside. This comes from one of Wall Street's top stock pickers in Ivan Feinseth. On top of that, Mountain is a rated overall A in our Zen Ratings Quant model. It ranks in the top 5% of every stock we track. That includes particular strength for both financials and value. Top 3% for financials means it's an incredibly well-run company, whereas the top 2% showing for value means it is severely underpriced relative to those impressive growth prospects. The only real weakness, and no shocker to anybody, is momentum, where it earns a D. This makes sense given the serious decline from last year's highs. But as they say, one man's trash is another man's treasure. Indeed, there are many top Wall Street minds who think Mountain is a treasure, and so does the Zen Ratings system. Now it's time for you to consider if it deserves a spot in your portfolio. So that's my list of 5 attractive stocks. Now I want to hear what you have to say. So please share in the comment section below which of these 5 stocks is your favorite and why. Or perhaps there are other stocks you think investors should pile into. Spell it all out for the benefit of our community. Plus, I generally read all of your comments. Now, if you're interested in more timely investment topics, then check out the video that's popping up on your screen right now. In that one, I share 4 predictions for the oil market and what that means for our investment strategy in the weeks and months to come.